since dirt was invented, I think. Is that about right, Earl?
Well, we're both a whole lot younger.
We were both in the dirt business. Very, very good. Anyway, Earl's going to bring us up to date on all the different tax laws and situations. So sit back and relax. He always makes it a lot of fun. So Earl Salter, ladies and gentlemen, good job. Thank you, buddy. You don't need this.
No. Well, hello, everybody, and thank you for lunch. I came a long ways for a sandwich, but it was worth it. I passed out a whole bunch of these, okay? This is not what the seminar is about, but this is what's tax deductible to you on your tax return. There's a bunch more up there on the counter. Everybody should have one. I guarantee you in this group of about 75 people, whatever it is, that there's probably about 20 or 30 of you that haven't filed your tax returns yet because you filed for extensions. So you're going to need this. This is what's deductible on your tax return. If it's not on this sheet, it more than likely shouldn't be on your tax return. It's that simple. This is what it's all about. This is what the IRS wants to see. These are the categories we're looking for. This is what it's all about. So make sure you have one of these. Again, if it's not on this sheet, it more than likely shouldn't be on your tax return. So, we got some problems going on, and I want you to get your noses out of your computers. No more texting. If you pay attention, you just might learn something. Keep your ass out of jail and out of trouble. That's what it's all about. So you don't get sued. You don't want to find out how good your E&O insurance is. Nobody wants to do that. Then you got to employ me as an expert witness to bail Neil out because group got sued. I go to court too many times as an expert witness because agents didn't listen. Agents didn't know what the rules were on how to avoid a problem. Well, let me tell you what's going on right now. Franchise Tax Board, January 1 of 2013, just initiated a new rule on cancellation of debt on a personal residence. Brand new. They said that they will not go along with the federal government who says the cancellation of debt on a personal residence, even if it's a money purchase, the IRS says it's not taxable. Franchise Tax Board says it is. I got a call from an agent about a month ago. She said she got a call from a client who was all pissed off because he got a bill from the Franchise Tax Board for $12,000 for the 2013 tax return. I said, it's not your fault. It's the fault of the tax preparer. Because if the tax preparer was not a licensed preparer, she got what she deserved. Like going with an unlicensed real estate agent. If something goes wrong, it's your fault. You pick somebody like that. So what happened is the tax preparer used the same rules for the feds as it did on the state. State of California is not stupid. They nailed it right now. In other words, when you have a short sale, a foreclosure, or a repossession, from 2013 on, your client will have a tax liability to the state of California. It's that simple. So if you're not doing business on short sales, foreclosures, and repossessions, you're probably not selling anything. Because that's what it's all about right now, isn't it? That's what's going on. There's still a lot of them out there, not as many as there were a couple of years ago, but it's still out there. So if they get a cancellation of debt and they're going to get a 1099-C, you've all seen it, they have a tax problem with Franchise Tax Board. Not with IRS, but with Franchise Tax Board. The only thing I want you to do is be smart enough to recognize the problem and tell them, hey, you've got a potential tax problem because of the short sale. They're going to say, well, no, I don't because the federal government says I don't. That's true. State of California, January 1. 2013 says all bets are off. You got a problem with it. The only way that they can get out of that is if they are insolvent. That means they are upside down on everything. I had a client in my office a couple of weeks ago who was working with an insolvency program. House was upside down. They had a rental house was upside down. They owed money on their cars. They had credit card debt of about $50,000. I said, okay, how much money have you got in a retirement plan? He said $400,000. That's the end of that conversation. He's not insolvent. These are the things I need to look at. If you got a client that you think might be insolvent, then you have them talk to me. Let me ask them some questions over the phone, and then I can decide if I need to see them. But this is a real potential problem, especially if they are not insolvent. had one client that the most they've owed was about $40,000 to the state of California. They had a cancellation of debt of about $300. No problem with the IRS, but they had a big problem with the state of California because they both had retirement plans. These are things you got to remember. This is your job. This is what you do. You got to remember that these people have a potential problem, and you need to tell them to give me a call or come and talk to me or talk to their own accountant, but they need to know what's going on with this brand new law that really affected a lot of people for the 2013 tax filing. It was terrible. I mean, I saw people pay more money than they've ever paid because of the primary residence. Now, California has a very strange law that this is primary residence, this is everything else. If they have 4 units or less, a duplex, 4 units or less, and it goes into short sale. Big difference between short sale and foreclosure. Short sale almost always generates a HUD-1, right? Okay? Bank signs off on it, you're all done. If it's 4 or less, and the property's in California, and your client is a California resident, and there's a short sale, they will have no tax liability on debt forgiveness, but only if it's one of these, only if it's investment property, not primary residence. Doesn't make any difference why. Those are the rules. And if you forget what I tell you, if you forget these things, and your client's got a problem, call and talk to me. I know a lot of you do. But call and talk to me, and I'll help you with it, and I'll tell them whether your client's got a problem or not, because this is really a major situation with the cancellation of debt. You got 2 different schools of thought, one federal, one state, and the state has 2. Okay? And people say, well, that's not fair. Where's fair? Right, Pomona. That's where fair is. Got nothing to do with tax law.
Earl,
Yes.
for the 4 units, if it's a short sale, it's less than 4 units, they don't pay federal or California.
No, this is California law only.
Okay.
Federal government will come after them with a vengeance. State of California says no. And I tell people when I give seminars that if you've got a short sale or foreclosure, this is not an H&R Block transaction. You got to go to either an EA or CPA. An EA is an enrolled agent, which is what I am. I carry a special license issued by the federal government, issued by the U.S. Treasury Department, allows me to practice before their courts. Only the enrolled agent is licensed by the U.S. Treasury Department. CPAs are licensed by the state of California. The difference is I practice in every state. I carry a federal license. I can go to all the federal courts. CPAs cannot. They're licensed in California, and that's it. So if your client, if your tax preparer is not either an EA or a CPA, you could have a problem. Let me give you a scenario. Guy holds up a 7-Eleven, goes to jail for 7 years. He gets out of jail, and he can't even get a job as a target as a greeter. So he's got $63.25. He gets a PTIN license number, which is issued by the Internal Revenue Service to do tax returns, a PTIN number. So no background investigation, no schooling, no education, no college, doesn't have to graduate high school, just got out of jail, he can start doing tax returns. They're out there. They're out there. Guy puts up a little sign that says refunds guaranteed. Holy mackerel, people are flocking in. Don't let this happen to you. Make sure your tax preparer is licensed and certified and accredited. Now, we got another problem. The IRS is zeroing in on audits on people that are agents that are paying commissions. How many of you are brokers? A broker. How many of you are brokers? 1, 2, okay, 3. No, just 2 of you.
Me.
Only the broker, and Lydia, thank you, only the broker can pay a commission to a licensed agent. No exception. Only the broker can pay a commission to a licensed real estate agent. If you have a commission split with another agent, you got to make sure it's either paid out of escrow to both of you separately, or that your broker pays it to you separately. Let's say these 2 people right here have a split commission, $5,000 each. He gets a total of 10. He writes her a check for 5, gives her a 1099 for it. gets audited. She's okay because she claimed it as income. He can't deduct it because she's not a licensed, she's a licensed agent, but he's not a broker. He can't deduct it, even though he sent out a 1099. I run into real estate agents that know these rules every once in a while. So I'm telling you, you can't pay a commission to a licensed real estate agent unless you're a broker. So one of the problems, if you have, we don't write a referral fee. A lot of you pay out referral fees, okay? You pay out referral fees. Referral fees are not deductible. Assistant fees are, but referral fees aren't deductible because they're not paid to a licensed agent. Whether they were or not, you can't deduct them. So client says, well, gee, I wrote a check to the homeowner for $2,000 because I promised him I'd do that. What is that $2,000? That's a kickback. That's not legal. That'll cost you your license. Then you got to have someone like me bail you out. It's a kickback. You can't do that. So you don't deduct it. You don't put it on your tax return. Nobody knows about it. In this situation, if you're going to buy them some, let's say you're going to give them $1,000 for a washer dryer. Go buy the washer dryer yourself and write it off as cost of sales. Okay? But don't give them the money because you can't do it. Now, referral fees are probably one of the worst terms you could put on your tax return. And I promise you, there are a whole bunch of you here that got referral fees on their tax returns. Those are buzzwords the IRS looks for. And I guarantee you, a bunch of you got that on your return. Don't do it again. You got tax returns you're going to do now between October 15th and now? Or you're going to do next year's tax return? Don't use referral fees. That's what they're looking for. Use the word an assistant fee. What's the difference? When I handle tax audits, and one of my clients had about $8,000 paid to various assistants. The IRS agent said, I asked for the licensed agents. I said, no. He said, you can't deduct it. I said, yes, I can. He said, no, I can't. I said, yes, I can. Let me tell you what an assistant is. Okay? These are the reasons that I don't ever take my clients with me on a tax audit. Because you wouldn't know what to say. God forbid they'd ask you a question and you answer it. Now I'm in big trouble. An assistant is someone who sits on the open house. That's what I'm telling the auditor. An assistant is someone who sits on the open house and he walks around with the people when they come in to make sure they don't steal stuff. And he walks around and so opens the closet, opens this door, this is that, and he's paying attention and he's showing them the house. Now, if they want to make an offer, he's got to call the agent in. That assistant does not have to be licensed because he's not selling anything. That works. Now, you got to give him a 1099. You all know that. In order to pay a 1099, you got to have them sign a Form W-9. And if you don't have a Form W-9, all you got to do is call my office. My numbers, I got business cards over there, my phone number's there. We will email you a W-9. You don't write them a check until they sign the W-9, because after you write them a check, they're going to say, I'm not going to sign that form. Okay? You don't write them a check until they sign the W-9. Then in January, you send me all the copies of the W-9s with the client's amount of money they made, and I'll do the 1099s for you. You got to follow the rules. You want to deduct these expenses? You've got to follow the rules. These are things that are happening all the time, that are going on almost every day. You go out there on sit on an open house. I mean, you've got 4 or 5 houses going on one weekend. You can't sit them all, so you have somebody help you. And if you forget the things that I tell you about, you just got to give me a call. Yes, sir.
Earl, if the amount is less than $600, do we still have to issue them a 1099?
You know, $600 is the magic number, that you don't have to issue them a 1099. But if you've got the canceled check and you put down assistant fee, the IRS can't push it because it's not $600. However, $599 won't cut it. Okay? So if it's anywhere near $600, I say anything over $5, send them out a 1099. If you're going to give a client that you sold a house to some money, you want to give them a 1099? First of all, you can't do that. It's a kickback. But you're going to give them a 1099, that's not going to make them happy. They didn't know that was going to happen to them. So these are things you got to remember. That if you want to make a deal happen, you want to have some money go out, do it right, okay? If it's to a client, you can't do it. If it's to somebody you sold a house for, you can't do it because that's an illegal kickback, and that's not legal. I'm sure that's one of the questions on the test. Maybe some of you didn't pass that question, but that's got to be very careful. I see agents in my office that do it all the time. I get clients in and I'm looking at what they did here and I said, well, tell me what this is about. And they told me what it was. You can't do that. Then I looked to prepare the return. It was the guy that just got out of jail. Okay? He could care less. What are they going to do? Take his license? He didn't even have one. A PTIN number, he can go get another one. These are things you want to remember because they're happening right now. This is going to affect all of you. Unless you didn't sell anything, it's going to affect every one of you. In the next 3 or 4 months, it's going to happen. That HUD-1 is very important on a short sale. If there's no HUD-1, there's no short sale, and the state of California is going to give them a real problem when if they have a cancellation of debt. And I'm seeing this so much now that we never had a problem with before because Franchise Tax Board always went along with what the federal government did. Okay. Something else I tell you that I do for you, and I've got a few clients in here that I'm working on, is if you owe the government more money than you can afford to pay, more money than you could ever afford to pay, I can help make it go away. I can stop liens, I can stop levies, and I can stop garanchements. And every once in a while, somebody gets their check garantied because. And if you got a check guarantee, you got your commission guaranteed, that means they sent you a lot of letters and you paid no attention to them. I had a client bring in a stack of letters like this, all sent, registered. Not one of them was open. I said, what do you think these are, birthday wishes? Jesus, they're after you. They're after you. So you got to come into compliance. In order to come into compliance, most people that owe a lot of money haven't filed all their tax returns. And you know who you are. I'm not going to point you out. Probably the person you're sitting next to. Okay? Just get these tax returns filed. Even if you can't pay the tax, get the tax returns filed. Maybe we can do an offer and compromise. My offer and compromises are normally 15 cents on the dollar. That's about what I settle for with the IRS, and I do a lot of them. They're a big part of my business. If that doesn't work, I set up a payment plan. I can help set up an installment program for you. But I can make liens and levies and all that stuff go away if you come into compliance. To come into compliance, you've got to file tax returns. And you know what else you have to do? Estimated taxes quarterly. You say, what's that? You all know what that is. You're just not doing them. Most of you are start doing them. You got to pay quarterly. You got to come into compliance. If you want me to help you, you got to help me. So these are things that are going on right now. We're not going to get into this in detail because I'll be back in January with the new laws and the new things that are going on that may change some of these. But right now, this is what's happening right now. And I guarantee you there's a bunch of you that are going to do tax returns between now and October 15th. And if you need help with them, I can do that for you. And then next April 15th comes along, you can't file your tax return on time, all you got to do is make a phone call, I'll file for an extension for you, there's no charge for it. Extensions are free. But you need to make sure that you do that because the penalties for not filing or failing to file an extension are horrendous.
For us real estate agents, what would be a good general rule of thumb for you as far as setting aside a percentage of each one of our commission checks?
That's a good question, thank you. Question is, how much should you set aside out of each check, commission check, to pay your taxes? Without any question, I say 20%. Because you may only be in the 15% tax bracket, but you've also got 15% in self-employment tax, Social Security tax to pay. So I tell my clients, put 20% of your gross commission in a separate. How many of you attended a Mike Furry class? I know a bunch of you have, sure. Okay. Mike Furry tells you got to have 3 accounts. A personal, a business, and a tax account. And you label it your name, tax account, and you put 20% of your commission away so that when the quarter comes, you've got the money to pay it. And if you don't know how much you owe, all you got to do is call and talk to me, tell me what you've done, approximately what your expenses are, and I'll tell you how much to fill that form out for. Anytime I can handle questions and problems over the phone, there is no charge. All you got to do is call and talk to me, see if I can help you put something together. So all you gotta do is call me. And I know several of you have me on speed dial, and that's fine. Because you know, in your business and my business, if the phones don't ring, nothing's happening, right? Phone's gotta ring. I carry a cell phone just like you folks do. And I don't care where I am. I've called some people back from Montana, Utah, Idaho, if I'm fishing or doing something, but I always call back, just like you folks would return phone calls. So remember, I tell you 20% of your gross commission, put it aside so you can pay your quarterly taxes. Because at the end of the year, you don't wind up saying, well, I can't pay all that. Well, yeah, you had the money. You didn't put it away, you spent it. Put it away, and then you can pay your taxes. I think that's a good program. Thank you for the question. Good question. Okay, anything else? Any other questions? Okay, we're not going to go into anything else in detail, because I'll do that when I get back in January. But use this list, okay? Use this list. This is very important. You have a question, honey?
Yes. Okay, a client is selling a property, an investment property.
One of these, okay?
She is willing, is it 2 units? She's
Okay.
willing to carry the loan,
Okay.
okay? So she have to pay taxes
Okay.
at the time that she receives the money every month?
Okay, good question.
Or is it gonna be at the end when she receives
Okay, good
the
question.
total money?
Client's going to carry a note. They're going to carry a note for, let's say the note's $200,000. I'm grabbing $300,000. And it's a 10% note. They're going to carry it back for 15 years. Anybody in this room thinks it's going to go 15 years? No. Now, if your client wants to do a 1031 exchange, they can save all the taxes. They cannot save taxes doing a carryback, because that client's going to pay it off in 2, 3, 4 years. Then it's all due. All the taxes due, and they cannot do an exchange. They're going to pay it all.
Yes.
So anytime you have a client with a big note, you got to really advise them, say, hey, you could have a problem with this, because when it's paid off, then you pay all the taxes. Other than that, if they receive it over every month, they get the payment portion of the interest, all the interest is taxable, and a portion of the principal is taxable. And how much that is, I wouldn't know. I didn't do the tax return. But if they want to come in and talk to me, I can give them an idea of approximately how much of the principal is taxable and all of the interest is taxable. If they're going to carry back a small note, I don't worry about that. But if they think they're going to carry back a note for 15 years and enjoy all this interest, bull, won't take that long. They'll sell it or they'll refinance it or something's going to happen. Really be careful with your clients on a note carryback, because when that note gets paid off in 2 or 3 years, they're going to call you and say, oh, I got a pretty big prepayment penalty in there, but they're still going to owe all the tax. Everything. They saved nothing because it was paid off so quickly. Okay? It was paid off so quickly. Another problem I run into, and I had that just this morning. In fact, somebody here asked me the question about a primary residence. They didn't live in it for the full 2 years. They're moving. Okay? So client says, gee, how much tax are they going to owe? I said, well, let me ask you a question first. Why are they selling the house? They didn't live in it for 2 years. They lived in it for 18 months, married couple. I want to know why they're selling it. There's a term called extenuating circumstances. You should write that down because you're not going to remember it. Extenuating circumstances. You're laughing. You're going to write it down. You're not going to write it. You're going to remember it right. You know, I can remember what my clients tell me, but I never remember what my wife tells me. I have no idea how that happens. Now, only married people laugh. Single guys, they don't understand that one. They didn't get that. Okay? We go to a therapist. He says, when you talk to your clients, you're face to face, this far apart. So when you talk to your wife, she's telling you something, where are you? I said, well, I'm watching TV. She's in the bathroom hollering at me about something. Hell, I don't know. My clients always remember what my clients tell me. So, where were we? Personal residence. Okay? They're going to sell the personal residence. Extenuating circumstances. What is that? They got divorced. That happens. Just had a kid. That happens. Dad died. Mom had to move in. Lost a job. Took a cut in pay. The area's gang infested. They got holes in the house to prove it. I don't know, maybe they did it themselves. They got holes in the house. That's extenuating circumstances. They can prorate the 24 months, the $500,000. They can prorate for the amount of months they lived in it. They only lived in it 18 months. Instead of $500,000, they get $375,000. Profit was only $150,000. They have no tax problem. It's the same situation for a single person. You can prorate the $250,000. 18 months, he gets $187,000 instead of $200,000. profit was only 150, has no tax to pay. But there's got to be extenuating circumstances, something that was beyond their control that happened that they didn't realize was going to happen and they weren't ready for it. So when you have a client that's going to sell their house and they haven't lived in it for the full 24 months, they got a profit, call and talk to me. I'll tell you the kind of questions to ask your client. Because this happens a lot, doesn't it? You know, I had one this morning. Clients just wants to move because he wants to be closer to work. Okay. Had another one last week, just wants a bigger house. Can't help that. I want reasons as to why they're moving to see if I can help them. Okay? These are things that are going to come up in your business. Call and talk to me when you have these questions. Yes, sir.
How long is the married tax deduction good for? Like I had a client whose husband passed away, and now she's wanting to sell about a year after the husband passed.
Okay.
So how long is that $500,000 versus
Okay. Got a problem. One of them passed away. Okay, husband, more likely the husband. Was the husband passed away? Yeah, for some reason, it's kind of a rule, the husband goes first. You know, I told my wife I'm not going first. I am not going first. Better get that down. I'm not going first. So, let's say they paid $25,000 for the house 40 years ago. Husband dies. The house is now going to sell for $600,000. But when he died, it was worth $550,000. That's all that matters. What was it worth the day the old guy died? It's called stepped up basis. What was it worth when he died? Nothing else matters. You got that program here. It's called stepped up basis. You do a property profile and you find out what it was worth the day that person died. Nothing else matters. If I inherited the property, same rules. It have to be a husband and wife. This gentleman passed away and I got all his property. Yay! I got a stepped up basis on everything. Those are the rules. It doesn't make any difference where the property's at or how many properties they have or whether it's one of these or one of these. Everything that they own that is inherited, and you only inherit from someone who died, okay? Other than that's a gift, okay? You get a full stepped up basis for the value based on the time of the death of the decedent. There's no exception to that rule if they inherit the property. Okay?
Is that going to be the cost of value?
Pardon?
Is that going to be the cost of value?
That becomes the new basis. It doesn't go back to the $25,000 they paid for it. So let's say your client inherited the property at $550,000, but it was worth $500,000 when it passed away. She's got a $250,000 exclusion. She has no problem, right? Because it's only a $50,000 gain. She's got a $250,000 exclusion. No problem. These are things you got to remember. This is your job. Yes, sir. Way in the back.
The $250,000 exclusion, does that mean also apply to cancellation of debt?
Tell me that. What's he saying?
If say $250,000
Yeah.
exclusion, would that apply to cancellation of debt in a short sale?
No, it's got nothing to do with it. One's got nothing to do with the other. Different code sections altogether. One's got nothing to do with it. Yeah, thank you. Would the cancellation of debt have any bearing on the $250,000? No, it's got nothing to do with it. Got nothing to do with it at all. Yes, ma'am.
I have a question. Husband died in December. Wife is no longer in the house. She's moved into a retirement community.
Okay.
And so, does that fall under one of the conditions? I mean, if the house were to be sold, since she's not living there.
I wouldn't have a problem with that. I'd take the $500,000 exclusion. They're still married, and they're filing a joint tax return.
Well, the husband died.
Oh, the husband died.
The husband died
Okay.
in December, and she's in a retirement community.
Okay, then she's got 2 years to sell it.
Okay.
Because more than likely, she went in that retirement home, is not coming back, right? They'll probably carry her out of there. Okay. So, more than likely, I would got to sell it within 2 years, we've got a tax problem. There's another question here.
So on the death situation, they don't have to pay taxes on it because of this, and it gets moved to a stepped-up basis.
Right.
However, there's a maximum that I don't remember the exact word, but there's a maximum amount of deferral for the step-up. I think it's a $5 million or $5.6 million.
Yeah, because there's an exclusion on it, but Usually we don't see that, okay? The inheritance situation is $5 million. So, I don't know, anybody else sold a house for that much money here? I don't think so, probably not. If you were down at the beach, you might.
But it's an accumulation of assets.
Well, that could
All
be.
their assets.
What they might have to do is file a gift tax return. I tell people if you know that if someone's gifting it to somebody or something, they might have to file a gift tax return.